Very good morning, friends. So I hope you're all doing safe as well as healthy. Well, in the previous video, I started off with the introduction to India's 10, wherein we discussed mainly, you can say, the concept of reporting period. Today, in this particular video, I am going to talk in terms of the definition of India's 10, and I'm also going to basically draw a, you can say, a three-step model in terms of deciding whether the events are adjusting or non-adjusting in nature. So let's, I think, first of all, look at the definition, what is given in the text of the standard, and let's try to develop a three-step model based on the definition. जो बच्चे नवंबर 22 के लिए या मई 23 की अपनी तैयारी कर रहे हैं सीए फाइनल के लिए, उनके लिए अनअकैडमी पर मैं लेके आ रहा हूँ कॉम्प्रिहेंसिव कोर्स ऑन फाइनेंशियल रिपोर्टिंग, और इस बैच के अंदर 4 मई को आपके साथ जुड़ूंगा, और जिसके अंदर टाइमिंग्स मॉर्निंग में 6 to 8 रहेंगे। मंडे टू सैटरडे का लाइव बैच है, और इसके अंदर आपके साथ पूरे डिटेल्ड एनालिसिस में हम पूरा कोर्स कवर करेंगे, जिसके अंदर आपके साथ रिवाइज स्टडी मटेरियल, मॉक टेस्ट पेपर्स, रिविजनरी टेस्ट पेपर्स, पास्ट एग्जामिनेशन पेपर्स, एजुकेशन मटेरियल के आपके सिलेक्टेड क्वेश्चंस, और साथ में इंडेक्स बुलेटिन के क्वेश्चंस, और टेक्स्ट को लेके आपके साथ चीज़ों को इंटरप्रेट करेंगे। तो आप 4 मई से मुझे इस बैच के अंदर ज्वाइन कर सकते हैं। डिस्क्रिप्शन लिंक के अंदर आपको इस डिस्क्रिप्शन बॉक्स में लिंक मिलेगा, जिससे आप इस बैच को ज्वाइन कर सकते हैं, और साथ में 10% डिस्काउंट भी अवेल कर सकते हैं इस बैच को ज्वाइन करने के लिए। तो भाई किस बात का इंतज़ार है, आइए लेट्स क्रैक इट। If you read the definition which is given in the text of India's 10, it says events after the reporting period are those events favorable and unfavorable. Well, I think in the first instance, let's keep one thing in mind, that irrespective whether the events are favorable or unfavorable, they are incorporated in the books of accounts, provided the other parameters that they are adjusting events is met. You cannot avoid incorporating an event on the ground of prudence that it is something which is favorable and is going to have a favorable impact on the financial statement. So the definition makes it very clear that whether it is favorable or unfavorable. It says that occurs between the end of the reporting period and the date when financial statements are approved by the board of directors in case of a company, and by any other corresponding approving authority in case of any other entity. Well, I think the initial part of the definition gives you a very important input, on the basis of which we can develop a step number 1. The very first thing you should see in a particular situation is that what is the timing factor of the event. I call this as a cutoff date. When it says that it occurs between the end of the reporting period and the date when the financial statements are approved, so there is a cutoff date in between the in which the event should take place. So the first thing we should see is the event taking place between the two cutoff dates, the balance sheet date and the date when financial statements are approved. Because the event is not taking place between these two dates, then outrightly it cannot be a case of India's 10. So the first thing to be seen is that the event has to take place between the two cutoff dates. Now, there are two types of events which can be identified. One is what the standard says, adjusting events, wherein we will make adjustments to the assets, liability, income or expense as the case might be in the financial statements. It could lead to either changing the value of already recognized asset, liability, income, expense, or it could also result in recognizing items which were not recognized earlier. Get the point very clear that adjusting event is not simply making adjustments to what is already in the books of accounts. It could also lead to recognition of those assets and liability or even income and expenses which are not even there in the books of accounts. It says in clause A, the events which provide evidence of conditions that existed at the end of the reporting period, which means the step number 2 is asking yourself a question that is there a condition which is present on the balance sheet date. Now, if you say yes, there is a condition which is there on the balance sheet date, I go to the step number 3. And in that case, I would ask myself that am I getting any evidence related to those conditions or not? Like for example, if there is a court case which is going on that becomes a condition on the balance sheet date. And let's say if the court case gets settled post balance sheet date, then it becomes an evidence of the condition that existed on the balance sheet date. So step number one is looking at the timing factor of the event. Then step number two is looking at the presence of the condition. And the step number three is looking at whether evidence is available related to the conditions or not. If yes, it becomes an adjusting event. The clause number B says that those which are indicative of conditions that arose after the reporting period. Now, if there were no conditions on the balance sheet date and these conditions arose subsequently, then it is a non-adjusting event. It would become a subject matter of disclosure in the notes to accounts only and only if it is material in nature. So what is my overall three-step model? When I'm looking at a particular situation, I'll go with the step number one. Is the event taking place between the correct dates? That is the balance sheet date and the date of approval of financial statements? Yes. Is there a condition which is present on the balance sheet date? Yes. Let's go to the step number three. Otherwise, it's non-adjusting event. And in terms of step number three, are we getting evidence post balance sheet date? Yes, it's an adjusting event. But if you do not get evidence, then it becomes non-adjusting event. The moment it's an adjusting event, we will adjust the financial statements, whether it is asset, liability, income, expense, already recognized or unrecognized. And when it is non-adjusting event, it becomes a concept of only giving a disclosure in the notes to accounts. So this is how we can decide with a three-step model whether it's adjusting or non-adjusting in nature. I think in the next video, let's take a few examples with you in terms of applying this three-step model to get a little more clarity of thought. That's all in this particular video. Thank you for watching. Bye-bye and take care.